How's everyone doing? Hope you are ready for a great Labor Day weekend. I will be finishing up this book by Mark Mahaney, Nothing But Net. He's a top 1% institutional investor ranked analyst. He's an exceptional growth stock investor. He's now at Evercore. I'll be interviewing him on my podcast next Tuesday. So I'm thrilled for that. I always enjoy these because I have a very clear framework around how I invest. And these are different mental models I got to interact with. And hopefully that can improve my thought process and learn something new in the process and kind of share that with everyone. So I'm really excited about that. I'll also be interviewing on Thursday a longtime friend, Michael Weinberg. Michael Weinberg was a portfolio manager working with George Soros back in the day. Then he used to allocate to hedge funds. He was at FRM, which is a really big, one of these early, allocator shops. Really phenomenal guy. We'll talk about macro and China and all the rest. And then I have another macro interview with Jens Nordvig. So Jens Nordvig, you may know him, probably do if you follow the stuff I consume. Very thoughtful macro investor too. So I got a lot of great content coming up. It's great for me because I get to just test views and ideas live with other people. It's kind of like an outsourced CIO function, or not quite outsourced. I still make sure I hold my views. It's really testing them in a dialectic. I wanted to pull up with everyone here to share a few thoughts. First off, just quick check in on some macro growth to value thoughts there. Nvidia earnings. I did a post last night on Nvidia, but I actually wanted to share the Goldman model on Nvidia, and then I'll share our internal model and talk about Dell, SMCI, Hindenburg, retailers like Lulu. Lulu reported yesterday. How does that compare to Ulta, which Buffett bought, Abercrombie and Fitch? Then the other names in the market that are kind of interesting too. So we'll see how much ground we can cover in the next 45 minutes, but I hope you find this interesting. So first off, look, the macro data came out strong yesterday, right? We saw that initial claims, which are reported every Thursday, beat expectation. I'm going to share my screen here in a moment. This is consistent with our view that there is no recession, folks. There's no recession. The market flipped out when we had this aberrant non-farm payrolls report in early August, around August 4th, which created this, flash crash in connection with Japanese yen and some other negative news and an overbought technical positioning in growth stocks, right? It kind of had a confluence of all these factors at once. So I wrote this yesterday. I'm sharing my screen. And the other is GDP beat expectations. Okay, GDP's beating expectations. Kind of makes sense, right? You have, what's GDP? It's consumer spending plus government spending plus investment, which means CapEx, plus export minus import. You can kind of forget the last term. And the consumers, fine, real incomes are going up. It doesn't mean that the consumers aren't stretched. It doesn't mean that it's not a K-Street recovery. But on aggregate, consumer is doing well. They're doing fine. They got record balance sheet strength. Equity markets at all-time highs. House prices are appreciating. So, and then CapEx spending continues, right? You can see that in the hyperscalers. That cycle's not rolling over. We saw that after Y2K in the dot-com era. One day that'll happen, but it's not happening now. And the government's running 7% wartime deficits. Okay, so the GDP equation is up. And all that means is you get breadth expansion, right? You got rate cuts in sight. The market, last I checked, had a 38% probability of a 50 bips cut. I think it's going to be 25 bips cut. I think 3 in a row, 25 bips cut. And then the Fed pauses, waits, and sees. These are adjustment cuts, not a full rate cut. I believe the Fed is wrong on that. You've got record corporate earnings that beat expectations. You've got record employment. So, they're adding fuel to the fire here, and they capitulate. This is a non-consensus view. I think it's the correct view. You want to be non-consensus and correct. We have been right on these Fed calls thus far. We've been right on the economy being stronger than folks anticipated. We've been right on corporate earnings too. And I don't believe that's the right decision. But hey, look, you play the hand you have in front of you, and it's not a complaint. It will, I believe, lift asset prices around Q4. I think, the market will have to digest the fact that they're not going to get 50 bips in cuts. The economy is too strong for that. So Q4 should be fun. I had a video I did, I think, last week talking about what happened in 2019 when the Fed cut rates and did these adjustment cuts. And, Q4 was very robust. It didn't kick in immediately when these rate cuts started back in 2019, which was in July in that cycle, but it was quite robust at year end. And I expect small caps and mid caps to move. I'm seeing that now. I'm looking at, been stalking these two small cap stocks, waiting for a good entry. They're denying me a good entry. That's bullish, actually. They just keep moving up, grinding up higher. It's actually exactly what you want to go see. By the way, this weekend in the Lumina Ledger, I will be writing up a new small cap pick. It's an energy services business. I'm really excited about it. It's a quality compounder, attractive valuation, and a good entry, good fundamentals. I've never talked about it on Twitter, so I will write about it. We bought it this morning. You might get a better price than me. Who knows? So let's see. So that's on the macro front. I do believe that the S&P is going to struggle to get above 5,600. Looking bullish year end. I'll talk about Nvidia earnings in a moment. Things were dirt cheap around August 7th. We leaned in, I wrote about that. We were buying aggressively, filled our plate. The markets recovered. Now notice this. This is quite interesting. So compare. Let me show you the S&P 500 here. Now the S&P 500, broadly speaking, is about like half value, half growth. Okay, so you had this peak around July 16th, and this correction, and this recovery, and essentially you're back to all-time highs, almost. Right? It's not struggling to get past that level. It's 40 points above 5,600 or below 5,600. Right now you've got QQQ. Let's pull that up. QQQ is obviously tech. And tech just hasn't been able to recover and had a steeper drawdown as well. It's heavier, right? And this is evidence of the growth to value rotation, right? Look at Berkshire Hathaway. Berkshire Hathaway is up 30% plus year to date. The thing is like going parabolic now. I don't think it's a good time to buy Berkshire, by the way. You should buy the stocks Warren Buffett cannot buy because he's too big. It's got a forward PE of 26. That's mostly due to Apple, although he's been selling out the position. This is more expensive than the S&P, which has a forward PE of like around 21-ish, 20-ish. So even this value investor is now a growth stock investor effectively. And you compare that to Microsoft, let's say. This is a consensus AI tech name. It's consensus, so I don't own it, but I look at it, and year to date, how's it done? Not done that great. Right, so it's done year to date 10%. That's disappointing at the very least because it's expensive. This is all part of the growth to value rotation, right? There are millions of decisions that are being made primarily by institutional investors that ultimately set prices, especially for large cap stocks. And you can see this growth to value playing out. So what I believe has happened here is that you just had this acceleration off the October 23rd bottom. This is kind of hard to read. I try to annotate key events on my timeline here, but you had this extraordinary, this is October 30th, 2023, right? The correction ended on October 26th, just as the 10-year hit 5% interest rate. Bill Ackman put out a tweet saying, I think rates peaked here. Talk about investing as a social process. That's clear evidence right there. We agreed also, and we went long, but you had this extraordinary rally off the bottom, right? And it continued right up until March 8th, which was the State of the Union speech. So, and then you had this correction that ended around April 19th. But this was the move. This was a move that should have taken a year and a half or 2 years, and it happened in a very short period of time. Right, so SMH I'm looking at here, which is the dominant theme of the market, AI, 230. Down here, it was around 138. Let's do the quick math on what that is. 130 divided by 138. That's a 66% return in that category. So No, that's like a multi-year move. And we could do the math on what that would mean for QQQ, but it's significant. So returns were pulled forward significantly. This is what I mean when I've said from time to time that there's this hot ball of liquidity sloshing around in markets, and it pulls things forward. Then the ball of liquidity moves somewhere else, and it kind of drops whatever was holding. We saw that in Dell. We saw that in Dell earlier this year. We owned Dell in January. It did quite nicely. It was very cheap in January. Then it ran up 80%. We sold it around here, sold it too early, arguably, maybe not. Then it went parabolic. Then earnings came out and it dropped 20%, and then it tanked, and now it's kind of recovering. So this is what I mean by this hot ball of liquidity. Now, this should have been this should have been a 2-year move. So this is an unusual market. We did not see this in the 2010s. Dell's up 4% on earnings. I'll talk about Dell and SMCI later. I'm just trying to start with the big picture now. So, I had dinner with a very thoughtful investor. He's in his 80s, sharp as a tack. And, he's met some seminal investors that all have nice palaces around the Hamptons, all the rest, names you would know, like Third Point, all the rest, right? And he asked me this question. He said, hey, what kind you should I expect? He's a client now. And usually people are looking like for a number, which is actually the wrong way to think about it. Then he answered his own question. He said, the return I expect is what the market can offer. And that sounds tautological, but it's actually not. And when he said that, I said, wow, this person really gets it. It's a very thoughtful answer, because what's on offer by the market depends on the condition in the market. So here's the S&P 500. Here's August 7th. I posted on Twitter on that morning and also on the Friday before at the close, right? So Monday morning, you wake up, you're here. I said, you should be buying, because 1 month later, we're going to be higher. We're a month later, it's higher, right? The risk reward at that moment was exceptional. It was exceptional. So if you say, oh, you should expect 10% return a year out, that's actually the wrong answer, because it depends on the condition of the market. So here, the risk reward was very strong. Here was very poor around July 16th. You had these YOLO call option activity here. Nvidia was going parabolic. Kathy Wood bought Nvidia, topped the market, and ARKW. There's a terrible risk reward. And the answer to this question, what the market can deliver, actually changes over time. Now, normally it shouldn't change that much, because it should be a function of valuation and macro conditions, sentiment, and other things. And valuation shouldn't change that much. Sentiment shouldn't change that much. It should be mostly static for quarters to quarters, right? Because those variables aren't moving. But this is a different market. This is a different market. It is. And if you're tuned to that, I think you can improve on how you invest and take advantage of tactics. It's one of the reasons why I'm taking a close look at Lumina ETF, because the problem is, if you take advantage of these tactics, then you pay short-term capital gains. Like we sold Dell, we had to pay taxes. I'm glad we did it, because it dropped, kind of went back to January prices. So, we're exploring this because the IRS does not view in-kind transactions as taxable. I don't think people realize how amazing that is. It's a big tax loophole. If you invest in real estate and you've ever done a 1031D exchange in real estate, you can buy a property, not your home, but let's say commercial real estate, and if you sell it and you buy another real estate asset within a certain time frame, you don't pay capital gains on the former asset. This is why real estate empires grow over time. People know this, and they don't want to pay taxes, and they compound. So ETFs have this tax advantage. It's extraordinary. It's not tax loss harvesting. It's in addition to tax loss harvesting. Tax loss harvesting, everyone should do. It's actually a good form of risk management. But for example, if Nvidia is overbought in June, you can rotate to something else with an in-kind transaction with the authorized participant. Think of them as the the market maker or the party that's manufacturing these baskets. So I think that's extraordinary. And it's like one of the things, like once you see it, you can't unsee it. Anyway, this is our high level approach. It's very unique. I believe what we're doing because we're cross asset class and macro where top down, bottom up, looking at factors. So if you think that's interesting, definitely fill out that form. If we get to like 500 form fills, then we'll go ahead and launch this, right? I think it just makes sense to go ahead and launch this, and we'll roll our separately managed accounts into it. Until then, we'll keep doing what we are doing. So let me shift gears now and get back to the main agenda. So Nvidia earnings. Let me walk you through highlights what Goldman said. I'll show where I believe they're wrong on this. Like net, we're both bullish on this. I have a higher price target. That's the headline. Goldman's price target, I think you might kind of crack up when you see it. Actually, they have a buy rating on it, but I think it's too low. Now, timing this is a different question, though. I don't think Nvidia moves in the near term. I think it really gets going a bit later when analysts start raising their price targets. So, well, this is from August 18th. Actually, I have a later version of this I can pull up here, but so 12-month price target 135. They're talking 2025 August 135 price target. That doesn't make any sense to me. That's off. So give me a quick moment here. I'm actually gonna find this. I'm going to find this report, the latest report, and pull that up on screen for you. And we'll talk through that. The main difference I have with Goldman is the revenue growth rate assumption on Nvidia. I believe Nvidia will maintain a 20% revenue growth rate for several years to come. And Goldman does not believe that. So that's what the entire difference turns on. We have similar gross margin assumptions. I believe we're in the early stage of GPU investment. You've got these hyperscalers, Google, Meta, Nvidia, and others. Now you're talking about countries like Malaysia and Saudi Arabia investing in data center. And they need to invest in AI to maintain their relevance and competitive advantage. And they're loaded with free cash flow. You've also got the venture ecosystem. Remember, AWS took off in part in the 2010s because a lot of venture money ultimately was funneled back to AWS. I think it's something like 35% of every venture dollar Amazon captured and monetized. So that entire cycle is happening again. And the cost of not being AI relevant to these hyperscalers is dramatic, because if you lose the game, you lose your future relevance. Your multiple is going to compress from whatever it is to a lot lower. And that means $1 trillion in market cap loss, because that's how big these companies are. So how much are you willing to invest to preserve that? A lot. Are you going to spend $50 billion in CapEx? Absolutely. In fact, they've said that. In fact, you'll spend $100 billion. They've said that too. Amazon, Meta, and Google. They said they'll spend that much. And it's rational for them to do that. Why is that going to stop? And to the winner goes the spoils. If you're number one in the market, you capture the lion's share of the prizes. That's how markets work. And if you're number two, well, you're like Pepsi. Pepsi's a great business, but it's no Coke. If you're number three, you're like RC Cola, right? What have you seen Glenn Ross? Steak Knives is number three, right? Or no, I think You're Fired is number three, actually. Number one is you get like a card. Anyone know it? You can put in the comments. Number one is, I don't know, it's a big prize. Number two, you get Steak Knives. Number three is like You're Fired. That's the prize in Glenn Ross. Amazing movie. You should watch it this weekend if you have not seen it. Amazing cast as well. They're all quite younger too. All right. I love movies, by the way. I love classic movies. So here we go. Here's CapEx forecast for hyperscalers: Microsoft, Google, AWS, Meta. Number go up. Number not going to stop going up. Okay. So the market sees this growth. If you look at consensus next year, and even a good chunk of this year beyond that, it's the year after that is where we have a variant perception. than the market. By the way, remember, 3 ways to make money in the market. 1, have a variant perception. 2, provide liquidity. All right. That's another way of saying be greedy when people are fearful. It's happened on August 7th. And the third is you have an information processing advantage. That means speed, right? This is one of the reasons I make fun of these guys because they're too slow. They have these committees that have to get together, make decisions, and then they have to get over these non-consensus challenges and all this other stuff, right? They can't move that fast. So I'm going to share my model with you. This is actually analyst on our team built this model. We have an 8-person team at Illumida. Believe me, I promise you, it's not just me. And you can see them on our website. I'm going to share my screen with you here. CFA built this. Don't hold it against him. It's not going to look as pretty as the Goldman report, but look, we focus on speed. That's the key. So this is where I want to turn your attention to this. So this is, NVIDIA's current PE right there. It's like in the 90s. And then we expect the PE to compress over time, the current PE. Actually, I think it'll be more elevated in this, but this is a typical kind of DCF model. A DCF model, what you're doing briefly is you model out the P&L, revenue, margins, free cash flow. Notably, they say they want to have $50 billion in buybacks, which will reduce the share count. That'll increase earnings per share. And then you get to a table like this. And you can model out what you think the P will be in the outer year. So here's where we are today. Next year, 40. Year after that, 27. 22. I don't think it actually gets there. If they maintain their growth rate, this never happens. And this PE stays elevated and stock does quite well. So take a look here. We model the fair value of this business actually around like $120 a share, $120 per share. I'm not going to walk you through the math how we get there. If you do a full DCF, that's what you get. The current price for Nvidia is something less than that. Right? It's 118. Actually, the market and I were actually pretty close on fair value. I think it's 116 this morning. We bought a few weeks ago. I published that on Twitter. It was in the hundreds, somewhere around there. So we're not buying here. We have our fill. What are we going to do there? And I don't think it really moves because there's growth to value rotation right now. I think Q1 next year, I think it'll do nicely. I think November, December probably does well, but we have to reassess when we get closer to that, right? So that's basically the difference that we have with the analysts, right? If I look at, here's another way to look at it. Let's take a look at this. If I look at analyst estimates, you can see the revenue projections that the street has on Nvidia. So analysts expect a doubling in revenue next year, then 40%, then 16%, 11%. So where we differ is we think these numbers are going to be like 20% here. We think this is a bit higher. We think this is around 20% too. And those differences are material. They're material to earnings. We don't think this happens. It's 5%, 12%. We don't think that happens. So that gets you to a higher price target. Okay. Now, the big risks to NVIDIA are the following. One is custom silicon, right? So Microsoft is NVIDIA's largest customer. I'm going to share a screen with you. This is a great chart showing NVIDIA's customers and key suppliers. It's not 100% accurate. These are estimated. Not all this data is in the public domain. So it's kind of a guess. So Microsoft's the biggest customer. That really means OpenAI, right? And by the way, it's not even Microsoft. It's CoreWeave that's supplying all this, right? Microsoft is writing a check to CoreWeave. Full disclosure of investment in CoreWeave. They're the neo cloud that powers OpenAI. And NVIDIA's investment in CoreWeave. How funny is that? And NVIDIA is looking to make an investment in OpenAI along with Microsoft. You guys saw that article yesterday. So, Microsoft margins are getting pressured. They're spending more on CapEx. You see Microsoft stock is lagging. We saw that. It's up 9%. It's lagging QQQ. And it's consensus and overpriced. And Microsoft doesn't have a great hand from a shareholder perspective to play here, don't they? They really don't. So NVIDIA took one for the team. They lowered their margin from the high 70s or 80% to 75%. Why did they do that? They did that because Taiwan Semiconductor said they wanted to raise prices. So someone has to eat that cost. It's either Nvidia or these folks on the right-hand side. And Nvidia ate it. Nvidia ate the cost. I think it's a smart move, right? Like if Microsoft, their stock ain't doing too well. If they're going to pay a lot more on GPU chips, the stock's not going to do that much better. It's not. I think I think they made the right decision on this. It's an ecosystem. You got to make sure people have enough to eat around the table. Nvidia has been doing real well here. They're doing so well. They generate so much free cash flow that they're taking half of it to buy back the stock. Don't forget, by the way, Nvidia is a chip design company. They don't even make the chips. Their business is intellectual property. It's thinking and software that helps them think better. What an incredible business, right? So that's Microsoft. And the risk is the CUDA layer, which is their moat, right? CUDA is the programming language that all these developers are trained on at Carnegie Mellon and MIT. And they want to code in CUDA. And, it's a mistake to not use CUDA because you develop slower, and that means you lose the race to be first. And this is a race. So if you're in a speed game, you got to be number one and you got to pay up. That's how speed games work, because the cost of being wrong is too high. The cost of being second is too high. So there are companies that are developing a translation layer where you can abstract away the hardware, very much like a virtual machine, right? The rise of virtual machines created clouds as we know them today. You could go from physically co-located data center technology to a virtual cloud. And the virtual layers would unlock that new delivery model. So there are firms trying to work on this. Like, can we have a translation layer for CUDA? I don't think that happens the next year or so. It takes time to write these kernels and so forth, but that's a risk to watch. This is a really cool company, actually. This company, it's public, actually. So I think I can share the screen and tell you what they're doing here. I don't think they will mind. I got to get the spelling of this thing right. And I'm probably going to butcher it as well. So, all right, I might have to find it for you later. I'll go to the website. But the headline is this. So what they are doing is, so think about if high frequency trading firms use this technology called flexible gate programming arrays, FPGAs. It's been around for a long time, this technology, like, I don't know, 15, 18, 20 years or so. And what you can do is you can take software and make the software physical through an FPGA. FPGAs is actually a form of hardware, but it's easy to program. You instantiate the software, and so it runs faster, provides low latency. So this startup, they're well-funded, they're venture-backed, incredible team. What they are going to do is allow you to take your LLM and you can create a molding for the LLM. Taiwan Semiconductor will manufacture this, and it's coded physical form. That's going to run much faster and lower cost. So that should take a share of the revenue away from Nvidia, some share. What use case they're going after, I don't know. What customer segment, I don't know. I think it's very, very clever what they are up to, though. I have no doubt Nvidia will try to buy that company. Nvidia is acquiring companies, by the way, right? They're very acquisitive. They would have bought ARM if they could have, and they are acquiring other firms as well. They're doing everything they can to maintain their competitive advantage and dominance. So it's going to be a lot to see with Nvidia here in the next, next few years. So what's the third bear case? Well, custom silicon, right? If Meta knows how to make chips, so does Apple, so does Google, so does Microsoft, so does Amazon. Amazon has their own chips too. Amazon's been hoping that developers use their chips or not. They want to use Nvidia because of speed and CUDA and all the rest. Google has their own chips, and Google is very, very good at this game. So I love Google for so many reasons, not just evaluation. There's so many embedded real options, I call them. There's so many ways to win. It's a simple way to think about it. And that's yet another. And they're ahead of the other hyperscalers on all this custom silicon. They've been working with Broadcom on this for a while. But there will be a day where cost optimization matters. So you look at like the cloud wars. In the early days, again, it was a speed race, but then startups and companies started to refactor how they use the cloud and focus on cost optimization. When that happens, then developers will say, okay, how do we translate what we do with CUDA to like a lower cost execution model? That's not going to happen now, but it will at some point in a few years, right? So those are the three risks. Again, custom silicon, startups that have these new technologies to chip away at Nvidia in different areas, and then reverse engineering CUDA with these translation layers. So, you never want to fall in love with your stock. You always want to look at the bear case. By the way, if time willing, I'll show you the Lulu AI. It's super cool. All right, now let's move on to the next topic. So like my price target for Nvidia, I think it's over 200 next year. That's where we are. It's a top holding, has been a top holding since, beginning of this year. In big tech, we like Nvidia, Meta, Google, we like App, and then we have a couple other holdings there. Oh, ASML, of course. We picked up ASML after that dip. That was great. We owned it October 23rd. Then at the Irisone conference in April, it became consented and go anywhere. Actually corrected. I mean, it's a classic example of the power of non-consensus investing, right? So, we think we got a fair price on a great business. I wish I could have bought it cheaper. I'm not over the moon happy with the price, but I think it'll do well. It's a compounder. They're a monopoly. The semiconductor ecosystem is full of monopolies. You got Nvidia, they're a monopoly. They're fueled by Taiwan Semiconductor. They're another monopoly, also a great business. I think that's a bit up now. And then you've got ASML, which powers them, another monopoly. And there are other monopolies around this ecosystem too. There are other memory companies we like. I'll talk about them later. Applied Materials pretty cheap right now, 4 PE 20. We bought some of that this morning, by the way. AMAT's cheaper than all those companies I just mentioned, by the way. Take a look at Applied Materials. All right, so let me show you AMAT real quick, actually, since we're on that topic here. Why not? I didn't intend to go down that path, but here we are. So as I mentioned, I'm focused on, if the S&P is 50-50 growth and value, I want to be 60% value, 40% growth, right? I still own growth stocks. Diversification does work. Just own best ideas. This is AMAT. It's 21 Ford PE. And, right off the trend line. It's an excellent business. I like this. I like KLAC also. I've been watching KLAC for a time, but AMAT is cheaper. 27 Ford PE on KLAC. The entry is not as attractive as AMAT. I think this is quite interesting. And business has good return on equity, 40%. That allows it to grow and it means the return on projects and investment is high. They don't have buybacks. It's not like my value stocks. It is expensive relative to its own history. You can see that. It's in the top decile, top 2 decile evaluation relative to its own history. That's also true for all of semiconductors. So what you're betting on is that there's going to be earnings growth that justifies that. That's what the bet is. Okay. Here's Taiwan Semiconductor. It's also in the higher end of its relative valuation. TSM actually not, interesting valuation. By the way, last year around this time, TSM had like a 15 or 16 times forward earnings. How wild is that? So it's an interesting business. I think everyone knows this is a great business, though. I think it's a little bit pricey. I don't know. Interesting business, though, for sure. So it's a world-class business. The question is, can you get in? Can you get it in? Can you get in there at a great price? That's the question, right? So Dell reported, did well, and stock's up 3.5%. Let me share my screen again. We were on Team Dell, and then we switched to Team SMCI. Wish I just switched to some other team. But there's Dell year to date, done quite well. We got in here, it ran up there. I mentioned earlier, sold off after earnings. My thinking on these businesses has changed a bit. Like this is something you see in markets often. It's the party that controls the last customer on the supply chain that captures most of the value, right? Nvidia builds their chips with components from Ace Technology, from SK Hynix and Micron and Taiwan Semiconductor. And Nvidia captures the bulk of the value because it's the value unlock from stitching all those components together in a way that creates new value, and they have the lock on the relationship with the end customer, right? Whereas arguably those other firms could be swapped out. You could play SK Hynix off of Micron. You can play Taiwan Semiconductor off of Global Foundries. I don't think you really can do that, but theoretically you could. They're both foundries or Intel. So Dell and SMCI, they're part of the distribution chain for NVIDIA. That was actually our initial thesis. We said, follow the NVIDIA supply chain, follow the NVIDIA distribution chain, and pick the leaders along both of those. That was our approach. And I think that's still a very good approach on the supply chain. On the distribution chain, I'm less convinced. I like CoreWeave because I unlock a lot of value in a lot of different ways there. I'll leave that topic for another time. Take a look at my interview with Nick Carter, who's a seed investor in what we now call CoreWeave. That was published about a month ago or so. But these guys are in competition with each other, and so is HPQ. And competition means margins, margin compression. So at the right price, these are assets worth buying. But my thinking on this has changed a bit. It's really that, right? I'd rather own the players that have a lock on the end customer. Think of it this way, like we'll get to Lulu in a moment, but what makes Lulu phenomenal is their brand, and people love the athleisure products. Yeah, you can invest in one of the suppliers, like the manufacturer in China or Vietnam of the clothing, but they supply a bunch of others, but that's not actually what creates the value. Lulu can charge a higher margin because of the brand and the relationship they have with their clients and the service model, all the rest. And so that's my thinking on semiconductors and Dell and SMCI as well. I'll pull up SMCI. So SMCI, so after Dell got expensive here, we said, all right, we're going to sell that. Fortunately, we kind of ate our taxable gains for our taxable accounts. And then SMCI, we got in somewhere here at a nice 20% rally. Really happy with that. And this is when it started breaking down technically, we sold half of our position, just good risk management. Just sold half our position, Then around here, where were we? I'm trying to remember what exactly we did. We tax those harvests a bit more. We still had a residual position. I have about a point today, by the way. This is risk management. And I'll tell you this, that Hindenburg report, I did a study showing what happened over the last 3 Hindenburg reports. The headline is, for 2 of them, Axos Bank and what was the other ones? Axos, there's Adani, there's a third one, someone here might remember. Axos, the day of, that was the bottom. For Adani, it bottomed within a month. It actually had 2 bottoms. It bottomed within 2 weeks, then it rallied, then bottomed again. And at the end of the month, that would have been a good buy. And then it's essentially back to where it was, which is a great win for people that did that. I will say this, there's a different fact pattern with SMCI in that the day after the Hindenburg report, they announced they're going to have a delayed filing. I mean, that's like a gun to head moment. That's a gun to head moment. I was surprised. I mean, it's very damning. That validates arguably a lot of what Hindenburg was saying. So look, this stock got whacked. I don't have a view on it now. I don't want to go dumpster diving here. I think there are other opportunities with good value. It could very well, if it plays out like there's other Hindenburg stories, and a lot of shorts cover, including Hindenburg. I wouldn't be surprised if they cover the morning of or soon or now, et cetera. I wouldn't be surprised. I don't know if they're doing that or not. That is a very typical pattern. I used to invest in a long short hedge fund called Carisdale. They pioneered the strategy, actually. They would build a short position and then they would share their thesis publicly. They have a lot of evidence. They'd be evidence-backed and researched. And then they would cover within a month. It was a form of event-driven alpha creation where they create their own events. Kind of amazing, actually, if you think about it, right? Not investing in that fund now. So I don't think the performance has been that strong. They shorted MicroStrategy recently. I don't know. I'm not a huge fan of long short hedge funds. I think they're overrated and they charge too much. So That is SMCI. Okay. Let's shift gears now and talk about Lulu and Abercrombie and Fitch and Ulta. So Lulu reported. Lulu, the results were actually good in almost every dimension. So I was surprised with Lulu. Uh, here. So I'm gonna pull my Lulu notes now. Um, so they outperformed in the men's category by 11%. They had 34% growth in mainland China. Now, by and large, the pattern for brands in China is that they underperform and they miss. That's been the story for Nike. That's been the story for Starbucks. It was a story for Lulu's. They beat in China also. And they repurchased $584 million worth of stock in Q2. That was not enough to stem this decline that we see in Lulu. I'm going to pull up the chart here for Lulu. I'm actually not too excited about Lulu, by the way. I'll try by, but I was impressed with what they delivered. They have a buyback yield of 4%. That's not too bad. Also, not too bad. Free cash flow yield of 6%. I mean, they're retiring 4% of their stock every year. So, I think they did execute. Now, their top line revenue growth is not consistent with a growth stock. That is an issue. That means they're not going to get a multiple in the 20s unless markets go la-la, which maybe happens, but then you're not supposed to own at that level. So they're like in the low teens revenue growth rate. Okay, so it is a great brand though. It's a nice brand. The issue I have with Lulu is it's actually the reason why we didn't buy the dip on Lulu initially when it was all over Twitter. Like here, they dropped on earnings. A lot of people bought the dip here. We did not. And the reason why I did buy Lulu later, and then we tax loss harvested, we got in too early, rotated to Abercrombie and Fitch. And the reason why is because one, valuation, 14.4 Ford PE, cheaper than Lulu. And that matters. That matters. Relative value matters. Lulu, Abercrombie Fitch is up 2.7% today. Lulu's down 78 bips. That's just one day. One day is not a trend, but well, Lulu's in a downtrend. Abercrombie's an uptrend. Abercrombie also had strong results as well in their Hollister brand. So I'll share some highlights with you. Their margins improved. They had share buybacks, not a lot, but they have 200 million in authorizations. Not a huge percentage of their market cap, to be clear. And I'm going to share my screen here to show you some of their highlights. By the way, the bigger question here is like, do you want to own retailers? Right? That's worth asking also. I'm not terribly excited about the category at large. But if I'm benchmarked the S&P 500, then I kind of need to have some exposure to it and need to find the best way to get that exposure. I'm not going to get the exact weighting to the S&P for that category. I'll probably underweight it actually, but I do need to have some exposure there. So their net sales of $1 billion, up 21% from last year, with comparable sales growth 18%. That's impressive. That's impressive. So same store sales growth up 18% year over year. The Hollister brands accelerating growth. Mostly across retail, you're not seeing these numbers. I don't know any other brand that's showing these kinds of numbers, both on the growth in the high teens, the margins were up. They increased our net sales growth outlook from 12 to 13%, operating margin in the range of 14 to 15%. Actually, there's another business called Dick's Sporting Goods. This is a boomer stock, and we have a whole theme on boomer stocks. Boomers are spending. They're taking their T-bills and they're spending. Dick's, though, is more expensive than ANF, so I'm not going to buy it, but I get the logic. I get the logic. It's at the right price. It's an asset that I would buy too. Amazon's not going to disrupt Dick's Sporting Goods. You got to try the golf clubs out in the store. Okay, there's Dick's Sporting Goods on the higher side of the valuation, but you can see valuation matters, right? Why does Abercrombie and Fitch have this trend? It's because at the start of the year, the thing was dirt cheap, right? It was dirt cheap at the beginning of the year. Investors notice. Investors like me that are valuation focused notice these things, buy the asset. Others start to notice, then a trend starts from the momentum builds. The momentum attracts other investors. We know statistically that momentum is a positive attribute for stocks, right? So it hits a 200-day moving average. We got in there. We like that. When it hits an average, then you pull the trigger. So now the interesting thing about Abercrombie is like, well, what would you rather buy? Would you rather buy? We talked about Taiwan Semiconductor. You can buy a monopoly at 20 times earnings, like Applied Materials or Taiwan Semiconductor, or you can buy a clothing retailer that's a brand. Brands can sometimes be fads. Remember Allbirds? Allbirds is gone. Allbirds is publicly traded. It's been a disaster. Or Rent the Runway. Those are fads, right? Fashion is fatty. Is fatty a word? I don't know. So, that's the question, actually. All these assets compete with one another in a competitive market. And I would pay up for a monopoly. Remember, like, what about Visa? We wrote about Visa. Remember Visa? I want to say 1 or 2 months ago, we wrote about Visa. These are world-class businesses. Visa, S&P Global, FICO, Moody's, Jack Henry. They're all way too expensive because the world knows they're world-class businesses. So hit the 200-day moving average here. That was a good opportunity. Here was another good opportunity. Now it's starting to recover, right? So that was your shot with Visa to own a world-class business, right? So problem is, if you own these businesses and you just buy them at these elevated prices, you're not going to get strong performance. So you really have to pick and choose those entries now, right? Right. There's American Express. There's FICO. FICO is, I believe, one of the world's most amazing businesses. I don't own it now. It's 62 forward PE. This thing is more expensive than Nvidia on the current PE. I think it's massively overvalued, but it is a world-class business that's not going to go anywhere. So the next time there's a massive bear market and crash, year-to-date return 47%. Look at that. That's behind us, so that's not forward return, right? Don't confuse the two. This is going into bubble territory now. This is part of the best versus the rest theme. The best stocks in the world all got bid up in the last 2 months of last year and the first 6 months of this year. S&P Global is another one, 34 forward PE. This business makes money by licensing to the S&P 500 name to all the indices that want to benchmark to the S&P 500. They get high fee income just through a trademark right on the S&P. And these indices have to pay basis points. What an incredible business model. Is that going to go away? No, it's not going to go away. As long as the S&P 500 is out there, right? That business model is better than Nvidia, arguably, right? It's not going to have the same kind of growth as Nvidia, but the longevity of cash flows will be there. So I have a list of world-class businesses we look at, and we just wait. We just wait for them to get cheap, and then we go buy them. That's it. So at the bottom of a bear market, you want to load up on the best businesses in the world, and then you wait. That's it. Would I buy it here? No, I would not. That's the issue. This what makes investing hard. And you have to respond to the opportunities that the market presents, right? Buying this here is like walking into a poker game with 6 people and the pot's not that attractive and you're the blind, if that analogy makes any sense. That's not interesting. The risk reward is much more attractive when you're at these moving averages or the valuation is more favorable, right? So what else did we have to discuss? I want to talk about the AI stuff. I mean, we are having a lot of fun with this, and I've teased at this a few times. I want to show you it in action. And if you want a view on a stock, please share it in the channel now, because I'll do it live. I can do it live on that stock. Okay, I'm going to pull up RAI now. This is like Lumina GPT. It's not meant to be user-friendly or look pretty at all, by the way. We use this for internal use. I have no idea if we're going to expose it to the public. I would like to in some capacity, but we have to think through what the model for that would look like. So 1 second here. Okay. All right, check it out. So what this will help me do is build a bull bear case on thousands of stocks. And it's going to go through the last 5 earnings transcripts and various buy side reports and put factors together. Man, it's not meant to look pretty. And it'll create a bull case, create a bear case, KPIs, earnings transcript highlights from management. And these are all indexed to be linked to what should drive investment decision. And the bull case, bear case is prioritized by impact. And the first bullet for the bull bear case is always around business quality. Okay. We've also trained this AI to be smart to different categories and disruption risk, because what matters in different industry groups can change. For example, in the home builder segment, the direction of mortgage rates matters. I believe the mortgage rate is going to drop. That's going to help home builders. That factor doesn't matter to other businesses. The 10-year matters more to growth stocks than mortgage rates, for instance, right? So we're iterating on our training, but it's pretty darn smart right now. And then it also has this really cool feature called read-through. So it links the stock to a higher level idea. So it says, hey, Nvidia is part of this higher level idea called AI. The reason why that matters is because markets are thematic. Markets love a good story. So if you can identify the higher level story you're part of, it might change how you orient. You might say, well, how do I best express my thematic view on AI? It also has company-specific read-throughs, meaning if I pulled up TSMC, for example, let's pull this up. TSMC is one of the first to report every earnings season, and they have a read-through on automotive, industrial, CPU, GPU. Okay, I might have broken it there. Let's see. It happens with demos, right? So what it should do is say, here are the other businesses in the ecosystem that should benefit. Okay. So can you do a short analysis on Hasbro? Sure. Let's go do that. I don't know this business. It's a gaming business. It's like they make games, right? Let's take a look. Let's see what we can do here. Hasbro. So one of the things I'd want to do, okay, I've got Hasbro loaded up now. I'm going to share my screen again. I'd want to compare Hasbro to all of its competitors first. That's important, right? You see it. I'm always doing that. I'm looking at opportunity cost of capital. The mistake people make is they get too focused on one security and not considering alternatives. So my factor model doesn't like Hasbro right now, first of all. Let's look at competitors. Okay. So yeah, it's got a story here. Growth in the Wizard of Coast segment because of certain games. I don't know these games, but cost savings measures, improved cash flow. They've been selling some assets. Yeah, positive outlook for digital gaming. I love the digital gaming sector. Sure, that's not going to stop. It's a bigger category than Hollywood. People live in games now. Continued decline in consumer products as families spend less on discretionary items. Well, that's an interesting point. I want to come back to that as well, because we've done some analysis on consumer behavior shifting. So increasingly challenging landscape, right? Look, that's in a competitive market. So who are the competitors to this business? I can ask the AI that. Who are Hasbro's competitors? And what I would want to do then is take those names. Okay, we got quite a few, right? Mattel, Funko, Lego Group, Spin Master, Playmobil, right? So let's go plug these guys in here. Okay. So yeah, it doesn't really like this category overall, it seems like. So yeah, none of them are really scoring that well. That itself is kind of a lesson, right? So what I can do with this is the following. Check this out. This is super, super cool. I find this really interesting. So I can load up all of the banks and ask it questions around the health of the consumer. All right, what other banks should we put in here? How about Citizens Financial Group? How about FCNCA? How about Innova? Not even a bank. How about Lending Club? How about American Express? We got Morgan Stanley, Goldman Sachs, Wells Fargo. We got a bunch in here, right? Okay, Innova's not in the model. Fine. So now I can have a conversation with the AI and ask it about recession risk, consumer credit risk, charge-off risk. First off, it likes the category of banks, my model. That's interesting. There's an insight there, right? Say, what is the health of the US consumer? How are consumer credit charge-offs performing? Is there any risk of a recession? And I can say, include stats and management quotes in your answer. This is the coolest part because I love verbatims from earnings transcripts. And we'll give it 10 seconds to go do this. I mean, this is an activity that would ordinarily take several analysts several days to go do. So it says, gradual increase in consumer charge-off, specifically in credit card and commercial real estate. But Bank of America notes that they're below historical levels. They are not alarming. And despite the pressures, consumer spending continues to exhibit resilience. It supports our no recession theory. The banks touch tens and tens of millions of consumers. So looking at their transcripts is a must do if you're trying to get a real-time view. These earnings statements are not revised generally, right? They say on recession, there's some warning signs, but it's a nuanced picture. They say Citi says they're seeing a slowdown in consumer and corporate borrowing. Okay. And, I could double click on that if I wanted to. How about this? This is really cool now too. Let me shift to retailers. So Lulu, Dick's Sporting Good, Abercrombie & Fitch, what else? Ulta, Walmart and Target, right? Walmart and Target reported well. They did quite well. But these other retailers haven't done so well. So now I can say, what are changes in consumer preference and behaviors? Now we have here we have it where the AI will actually tell you what questions you should ask it to learn more about your idea. We're having the AI teach us to be smarter investors. So I'm going to go with this first one. What are changes in consumer preferences and behavior? Now I could have loaded Louis Vuitton and Hermes and luxury, 20 brands in here. We're actually working on that over this week, and we're going to augment the data set so I can ask a question across an entire category instead of 5 or 8. And this is what it says. It says consumers are more environmentally conscious. There's a health and wellness focus. There's a shift to online e-com. There's value for money. Economic uncertainty has led to a heightened focus on value. Consumers seeking affordable options and quality products amidst rising cost of living. Well, isn't that Target and Walmart? Isn't that why Ross Stores reported well? Why TJ Maxx is doing well also? Let's add TJ Maxx in here. We could put Dollar General in here, right? Why don't we put Dollar General in here? And Dollar Tree, I think Dollar General got some act like 23% on earnings, right? Okay, so let's talk about that again. How are different segments of the U.S. consumer performing, e.g., low income, middle income, high end? Let's see what they have to say. So low-income consumers heavily impacted by inflation and rising costs of essential goods. They're turning to discount retailers to manage their budgets. Brands like Dollar General, Ross Stores are seeing increased sales as consumers seek affordability. Price sensitivity is high. Middle income experiencing mixed performance. Some are resilient, some seeking deals at traditional discount retailers. Retailers such as Target and Walmart are catering to this group by emphasizing promotions and digital offerings. On the high end, demand remains strong for premium brands, although there's been signs of slowing growth. Retailers like Lululemon and Ulta are maintaining their presence, driven by brand loyalty and focus on innovative products, but increasing competition may lead to cautious spending in this demographic. So that's great. How about this? Show me quotes from management illustrating the points above. Suppose I want to fact check it now. Let's see what they have to say. Now, you could do this for hyperscalers, right? You could say, hey, what's your CapEx spend? What are your plans for AI? What's your cloud roadmap going to look like? This is very powerful. So Dollar General CEO, we know that our customers need us even when they face economic challenges. The CFO says our customer continues to be value driven. Walmart's discussing e-commerce. Okay. Let's talk about e-com. We saw in the Bank of America spend report that there is a continued growth in e-commerce. Right? I'm going to share my screen there as well to show that. Let's take a look. Okay, so here we go. Bank of America has this credit card data, and they're a major issuer. It's like a real-time pulse of the consumer buy category. And you can see online retail continues to grow. This is the Amazon effect. You can see that you got green here for online retail. Furniture is in the dumps because people aren't moving because mortgage rates are high, but that's coming down. This could turn around at some point. And travel and leisure has been weak. People aren't driving so much, or gas prices are down. Entertainment is pulled back somewhat. But online retail is working, right? Department stores are in the dumps. Like companies like Macy's are continued to, I believe, get disrupted. Clothing and apparel are in the dumps, right? So let's see. Let's go back there now and talk about, retailer behavior patterns. So tell me about the shift to online e-commerce and how brands are adapting. Show me quotes, right? So yeah, look, I think this is pretty powerful. You can do this for any category here, any category that we track, and we can create themes on the fly. I created a theme for e-tailing, which is just e-commerce providers, for example, and create a theme for pets. So yeah, talking about Abercrombie & Fitch, digital engagement. Lulu has a big focus on digital engagement as well, robust e-commerce platform. So if you want to be a part of the future, better make sure that your retailer has a compelling e-commerce story. We could go to big tech firms here. These are the big tech companies like Mag7 and Friends, right? I can say, tell me about your investment, your CapEx investment in GPU compute. Do you expect it to continue? Show me verbatim quotes from management. So what I want to do actually is, now that we can ask an AI about a particular stock at a ticker level, I then want to kind of use recursive logic and ask the AI about all stocks within the theme, and then have it do a meta-analysis at the thematic level. Then once we have all of that done, then ask the AI to look across the themes to identify where the best risk reward is, where you should consider investing. So you can see it has different quotes. And it didn't give me the names of the people that gave the quotes, so I asked it to include that. So we got to refine this so that's all automatic. It's not giving me that right now. So yeah, in general, you're seeing continued investment in CapEx across these CEOs, CFOs, CTOs, and all the rest. So I thought it was super cool. All right. So I think we'll call it a wrap there. Let me see if I had anything else to share with you. I'll share this last chart. Okay. This is I thought this is quite interesting. It shows the short interest by category. Okay. And there you go. What you see here is that it's showing here the key sectors, the S&P, and it shows the short interest by category as a percentage of market cap and the percentile rank of that versus history. And right off the page, first thing you see, there's a lot of short interest in consumer staples. By the way, hedge funds are generally folks that would cause this short interest to happen. So, one, it's a bit crowded because a lot of that's happening. That sector has done well. All defensives have done well, right? Consumer staples have done well. Healthcare has done well. Utilities have done well. I think because people are afraid of recession. Now, if you believe that there's no recession, then that safe haven goes away and staples trade down. I think that's the logic there. I think that logic's actually right. I think it's actually good logic. And you can see that these defensive sectors, there are these negative bets on. It's quite interesting. It is a bit crowded though, so consider that. I'm not saying do this or now. I think this is very interesting. Just think about how folks are positioning around markets. Financials, no one's shorting. These have done quite well. Rates cuts are coming. It's going to heal the company balance sheet. They can extend loans. Consumer DQs, delinquencies, and charges, I believe, have peaked as well. I think several regionals will do quite well. I'm excited about small banks at the year end. I think the M&A cycle gets started there again. What else? Another one I'll show you here is the a sentiment measure. And this sentiment measure is the AAII survey, which is done weekly. And you can see our current levels, the red line. When this is at a peak, generally you get underperformance because everyone's already in the market. There's no one left to buy. When it's at a low, there's good opportunities then because everyone's pessimistic. People have too much cash. So you want to buy low, sell high. So, sentiment has recovered sharply. In fact, we had a peak in sentiment around 2021. So I think September, we've got to work off the enthusiasm we have from this very strong bounce off the bottom. And we had candidate Harris interviewed on CNN last night. I didn't watch it. I don't know. Was she asked about taxing unrealized capital gains? I would say this. My quick view there is that I think markets are going to start pricing in a candidate Harris bump. And that's probably negative for markets because of these kind of tax policy and raising taxes on corporates and all the rest. I'm not making a political comment here, but I'm just trying to read reality for what it is. I also think that markets are underestimating candidate Harris. She is running to the center. I saw her, she had a speech at the border and she was talking about her history as a prosecutor and being tough on transnational gangs. And tough on crime. That's a law and order message coming from a member of the progressive wing. And that's actually their optimal strategy, is to run to the center. That's what they're doing. So I think that could impact areas of the market that, we're betting on deregulation under a Trump regime. So that's something to consider. So anyway, I think S&P probably struggles to get past 5,600 this month. And I think you're going to see some chop over the weeks ahead, but excited about how we finish the year. All right. Have fun, folks. Enjoy your Labor Day weekend. Be well now. Take care. And tune into the podcast next Tuesday with Mark Mahaney. Again, one of the best top 1% analysts covering technology. Great book. I'm halfway through it. I have a lot of fun there. Be well now. Bye-bye.